Hello, everyone, and thank you so much for joining us here on the Citi Global Technology Conference, where this year we're going virtual, of course, given coronavirus. My name is Jim Suva. This fireside chat is with Seagate Technologies, and importantly, we have the Chief Executive Officer, Dave Mosley, joining us, as well as Shani Hudson, Senior Vice President in Investor Relations. I do want to remind people that there are disclosures associated with this, and they can be found on the Citigroup website, as well as Dave will have a few comments about the disclosures. And anybody subject to MiFID II needs to be reminded they need to have that research agreement in place. Anybody with press or media need to make sure they are not connected, and we will disconnect you automatically. Press and media are not invited to this. This is for investors only. So I want to first welcome Dave Mosley, and he's the Chief Executive Officer of Seagate. And Dave, I think you had a couple opening comments that you wanted to make. Dave?
Yeah, thanks, Jim, and thanks to all of those of you joining us today. Before starting, just a quick reminder, like Jim said, that I'll be making forward-looking statements, and you can learn more about those and the risk factors associated with them in our SEC filings, which are on our website at www.seagate.com. Let me just give a little context around a quick update on the current business environment. We're about two-thirds of the way through the September quarter, and the end market demands are trending well to our expectations. Coming off record levels in the June quarter, the cloud data centers continue to be strong. And we're obviously biased there because we have a lot of 16 terabyte demand, but the customer demand is actually very broad-based, spanning all geos. So we can talk about that if you have questions about it. Demand for video and image applications, including surveillance, has actually continued to pick up through this quarter. While the enterprise markets, the on-prem enterprise markets that I talked about in July, have actually remained soft. Although we do see indications for demand to improve as we progress throughout the year. So the net is that the September quarter is tracking pretty well with our expectations. And most importantly, the demand trends are improving in a couple of the key end markets, which supports our outlook for a flattish FY21 versus FY20 in revenue. Over the long term, which is really what we're focused on making our investments around, we remain confident in the growth of the data center and all the mass capacity that drives secular demand for mass capacity storage due to just data growth. And Seagate's obviously been a leader in mass capacity storage for quite some time. We continue to execute our technology transitions, our roadmap, product roadmap, and all our capital investments in order to meet the demands of the world, which are growing from a data perspective, leaps and bounds. We're also leveraging all this knowledge and our expertise in interfaces and interface technologies in the data center to actually service a broader world that's what we call the growing edge. The architectures, interfaces are changing a lot due to all the data movement that's going on in the world right now, what we call data sprawl. To that end, we plan to discuss some of this in our Seagate DataSphere event that's coming up pretty soon. On the 24th of September, we're going to host it all virtually. So I encourage you to participate if you can. There's information on our website, or you can contact IR and find out more about that. Really what we're talking about is how all the cloud data movement that's happened during the transitions that we've seen in the last 6 months, which have been wild, are going to actually mean that the on-prem side needs to grow as well to meet latency and cost and security requirements. So the cloud's going to grow very strongly, but we really believe in the edge as well. We think all these trends have been accelerated because of recent events, not decelerated. So we're pretty excited about it. We're going to talk more in our conference about that. With that, Jim, I'll open it up for questions.
Well, I think you kind of took my first questions about how's near term, and it sounds like it's, shaping up within expectations, which is great to hear. You did make a little comment that I picked up on. You said some demand end markets are improving. Just kind of curious, which ones are those? I mean, my kids have started school. They're doing a lot of cloud computing, cloud education, but yet the construction workers in my neighborhood really aren't doing much construction yet. And you talk about edge. So which end demand markets are you seeing are improving, Dave?
Right. So as I tick down through it, Jim, we talked about the on-prem enterprise being really strained. Private cloud, anything going on premises where people couldn't even get on premises in July, was being strained. And we see that through our distribution channel and some of our client server markets as well. Surveillance, though, it's a mass capacity application, and it has a lot to do with on-prem. It was strained as well. The good news for us is mass capacity surveillance is starting to come back, and so that I made comment to that earlier. And I think that's a function of not only people getting back on premises, but also looking for applications that help solve problems, smart cities problems, smart factory problems, smart hospital problems, all these things. So we do see that strengthening. The distribution channel itself is actually strengthening quite a bit in the quarter. And this is something that, frankly, the bullwhipping that was going on in supply chains between April, May, June, July, with factories being turned off and people having to pull inventory in because they were worried about getting any, and then seeing the true end demand was quite a ride. I think some of it's starting to stabilize there. The on-prem enterprise mission critical and small medium business that we made reference to is recovering, but it's very slow. And exactly to your point. And we're there for those customers. We need to pay attention to them. Some of them will come back. Others maybe change their business model. We believe the end demand around mass capacity storage is still going to be there, but the routes to market may actually change a little bit. We've just got to ride that through with everyone.
And Dave, with coronavirus and the pandemic, has it impacted your operational ways of doing things? A lot of companies are trying to be more nimble, trying to adjust your business practices. Companies are trying to be more efficient, but if you're doing temperature checks, you're doing a lot of more social distancing. Is it an impact to margins, long-term, near-term? Are you through the worst of it? Some countries saying Seagate can't, do normal business. Others saying you can open up. I'm in the Bay Area. Traffic is picking up. It seems like it's almost normal if you look at traffic now, but yet a lot of the parts of society, restaurants and hospitality really aren't even close yet to coming back. How should we think about the ways of the pandemic, the operational challenges, what you've done, and looking ahead, we should think about things?
Right. And it started early on in China, for example. Some of our China factories, we learned a lot in the very early stages of the pandemic about what are all the things we need to do to keep people safe, which I think we've done a great job of. It's a severe challenge, and you have to make sure you put safety first for all your people, obviously. To that end, we do still have permanent shifts, if you will, that cause some cost impact inside the supply chain, inside of our own factories. Social distancing, busing, things like that have changed permanently. I think as time goes on, we learn how to adapt to some of those things. And I would say that generally speaking, the cost impact will be less and less over time as we learn to adapt. But we still have to be mindful of safety first all the way throughout our supply chain. There's aspects of Seagate where we can do things remotely. There's other aspects where we obviously can't. And upstream in our supply chain as well, there's a lot of parts coming at us. So we have to make sure we're just mindful of that, sending the same messages to everyone.
And Dave, how should we think about Seagate's positioning in the current state of the competitive market? HDD versus flash, big debates of who's going to win out. Or reality, does one not need to win out versus the other? Can they coexist for, a decade or longer ahead? How should we think about your competitive position relative to competitors?
Yeah, if I think back ancient history now, there were some devices where hard drives were there that they got displaced by other technologies. I think when we start talking about legacy markets, some of them have longer tails, but we forecast that for a while that some of those markets are going to go down in volume quite a bit, in exabyte shares quite a bit, and they really have. I mean, notebook is a shadow of its former self from a hard drive perspective. Desktop, same thing, the low capacity. There still are high capacity applications in desktop, for example, in the distribution channel, and even in PCs, where we still see healthy growth, and we think that tail should asymptote somewhat. Right now, legacy markets are a smaller fraction than mass capacity are, and that's why we pivoted quite some time ago towards our investment there. There are other legacy markets here, exactly to your point, where because of the install base of, say, SAS slots out in the world, mission critical isn't going to go away right away. It's been, generally declining because nobody's really investing in it, but it's still a great cost performance solution for, some aspects of that market. Consumers, another example, to your point about people working from home, the consumer business, the gaming business inside the consumer have actually been quite healthy. But, those are still legacy markets where we're not really investing a lot. So.
And how should we think about industry growth rates? I think many people are kind of pinpointing around ballpark 40% Kegger. Is that right? Is the pandemic influencing this at all? And when I hear 40%, I tend to think about, wow, is there enough supply to meet demand?
Well, that's where we have come from. If you think about, the Kegger for mass capacity, most of that's been satisfied by oversupply, if you will, of heads and media that we had during the client server explosion. And remember, the peak of client server was 2012. So this isn't, it's not ancient history, at least not to me. But we've had to pivot factories quite quickly off of making so many notebook drives out in the world into so many, mass capacity drives out in the world. I think to your point, I think we're largely through that. 40% sounds like a great Kegger. We've already achieved the point where more than half of our revenue is mass capacity. And, from an exabyte perspective, it's even stronger than that. So we think at some point, then legacy becomes de minimis and it's all mass capacity at that 40% Kegger, in which case you get some kind of stabilization. I think that's your question.
Right. Now here's the head scratcher to me. High data growth, yet the industry and Seagate and all the players have struggled to have consistent revenue growth and margins. We've seen a lot of volatility to margins and a lot of data growth, whether I store it locally, in the cloud, hybrid, public cloud, private cloud, all these things. Simply, and there's been consolidation in the industry, why theoretically has revenue growth and margins not been stronger and more predictable?
Yeah, I think over the last couple of years, our revenue has been relatively flat, I'd say. And so when do we see that high Kegger that you referred to, the 40% Kegger really kicking in? I think COVID is actually accelerating that Kegger. That's my opinion. I think the cloud people are going to become more dependent upon the cloud and less dependent on legacy. But all of this is an interchange right now between, some of the legacy businesses hanging around, and hyper competitively too. I mean, there was a lot of competition for those last legacy slots. Eventually, data growth just overwhelms. And, I think we're at that inflection point. The question is, did it happen, 2 months ago or 2 years ago? I don't get really into that. It's more, we're making the investments over the long haul for, those mass capacity applications. And I think we've made the right investments.
Gotcha. Let's talk about the recent June quarter results. I think you saw pretty good demand in mass capacity, if my memory is correct. But I believe the surveillance saw some softness. And of course, small, mid-sized businesses saw a bit of a pause too. Can you talk us through a little bit about those end markets? And would you expect some type of recovery or resumption from some of these, especially the surveillance? I mean, small and mid-sized, you drive around, you can see which restaurants and small companies are being affected. But what about the surveillance side of it? Do you think that will come back? And if so, what necessitates a return to those areas?
Yeah, I do think on the mass capacity side, that surveillance market's already coming back. I'd count that as some of the smart city applications that you're starting to see. Some are reflective of COVID, and some of it's just the normal, mass capacity migrations we were seeing in the market anyway. If I think about facilities for large enterprises, they're becoming more and more data intensive. They need that data stored locally to process it, to make good decisions off of it. A lot of that data is video data, video and image data, but there's other kinds of sensors as well. And we think there's a lot of opportunities, not just smart cities, but factories and hospitals and all the other things that'll become smarter over time with new applications. That's what we're seeing right now is the demand for some new applications. I don't think there's going to be a lot of new camera installs first up, but I do think that using that video data to garner some more information out of the existing video streams will happen. And so that's usually where the hard drives lie, where the mass capacity storages lie there. On the cloud side, I would say that COVID disrupted everything. It certainly did on the cloud side as well. It's driven a lot of demand that's, you can see it, and the cloud vendors talk about this a lot, but not all that demand comes straight away the very first day. Sometimes they have to make sure that they meet service level agreements and everything else with their customers. So they have to call some really hard priorities. And juggling the growth that's happening in the cloud is a tough problem. We're convinced that these transitions we're talking of, because of the new economy, if you will, the new data economy, will actually accelerate the cloud. But it's going to be a little bit choppy at the start, I think. And, we like the fact that we have such a great portfolio. Our 16 terabyte is up the ramp. Our 18 terabytes ready to go. We can meet this demand whenever it comes.
And Dave, you actually dovetailed exactly into my next question. Can you talk a little bit about the technology and the roadmap a little bit, what you can about, I believe 16 terabyte is doing well, and I think 18 terabytes is kind of getting ready to ramp. Is my memory correct in that? And how should we think about, we hear a lot about HAMR and MAMR and customers, do they have readiness for that to adopt it, or how should we think about the roadmaps of your technology outlook?
Yeah, our 16 terabyte platform, we made a conscious decision about 5 or 6 quarters ago to just say, let's cut from the old and go onto this new platform because we have a lot of confidence in it. It's leverageable. That's why we don't have to change platforms, every 2 or 4 terabytes. We can actually leverage this thing way out. So the 16's quite far up the ramp now. We're really happy with the performance. And importantly, in order to turn to 18, we should change the heads, change the media, and change a little bit more. It's not a big change. And so we have a lot of confidence in our ability to pivot whenever the customers want to go there. The componentry, if you will, is way down the cost curves. We don't have to pay to amortize toolings. We're really confident in the cost structure of the platform, the quality of the platform. There's no initial startup hiccups, if you will. And, since we control the heads and media, I think we can actually control the ramp as well. It's leveraging the PMR technology of the past. So there's none of the new, heat assisted or, other energy assisted that people are talking about technologies in there. Although with our 20 terabyte, which we will ship it by the end of the calendar year here, we are going to introduce HAMR. So HAMR is heat assisted. It's actually markedly similar technology from a wafer perspective. There's some differences. Sure, there's differences, but it's not a complete wafer rip up. And importantly, it goes into the same platform that we've been staging, the same 16 terabyte, 18 terabyte platform. So that de-risks the technology transition that we have to go on. What we said in the earnings call in July is we're going to introduce this to the market and we're going to learn. So we have to get some out there in the field. We learn from controlling the products in our factory, releasing to the field and learn from the field. There's a lot of customers that are very interested in what we want to learn because, look, at the end of the day, they don't want to build more data centers. They'd rather have higher capacity drives satisfying all the extreme data demand, inside smaller footprint of data centers. And the way they do that is getting higher and higher capacity drives out. So we have a very attentive audience on this. They're going to help us in some cases, and we're pretty excited about it.
Great. And then how should we think about gross margins looking ahead? You mentioned 16 terabytes doing well, the ramping of it. Also, I'm just kind of wondering about, puts and takes. I think if my memory's right, you have a long-term gross margin target around 29 to 33. I don't know if that's accurate or if you can correct me on that, but talk about the puts and takes of margins and how we should think about that versus all the good things you talked about, the rampings and the technologies that are going on behind the scenes.
Yeah, the way we plan the business is I'd say midpoint of those ranges, and there's a lot of variables obviously that come into how we plan that. But the first order, think of it as how much supply are we going to need for the demand? What do we think the business picture looks like 1, 2, 3, 4 years from now, as to how we're planning. So we're still planning for those ranges. I think COVID has changed everything. So, we obviously took some cost increases as a function of that. And the demand picture has been fairly choppy because of COVID. So the tactical fight that we're in the middle of right now is largely more, from a margin perspective, largely more driven by those dynamics. long term, we expect certain parts of the market to continue to slough off like the legacy. We expect a lot of growth in the secular growth in mass capacity. We're pivoting all of our plans, our CapEx and everything else towards that. And, I'm very confident we can stay in those margin ranges, maybe even grow them. I think we're going to be thinking about that as, the fundamental constituents of the bill of materials become more in our control. Heads and media, that's what we make. And, that'll have to do with how much capacity do we really want to add versus what we're getting paid for.
And that 29 to 33%, is that still accurate, or is that my memory that I have from a long time ago that I need to kind of take that off the table, or how should I think about that?
Well, I think, yes, you remember that from a long time ago. I think tactically we don't really manage the business like that, but if it serves you to model, somewhere as far as how you model us out in time, that's still the way I think about it.
Perfect. COVID, the impact to your earnings. I think you quantified it or bracketed it last quarter. I think you said, if I remember right, 25 cents to 35 cents or something. Is that accurate? And will that kind of step down like a nickel per quarter, dime per quarter, or how long will this happen or prolong itself? I'm sure a lot of it has to do with what the governments allow you to do, don't allow you to do, and outside your control. But assuming the world progresses and we don't have another hiccup, how should we think about the impact that is impacting your earnings right now? And am I also correct with that 25 to 35 cents?
Yes, that's right. And I think you're thinking about it right. It's, we're working hard operationally to, make sure we find a way to improve our costs all the time. We do have to comply with all the laws. We have to make sure we're doing all the right safety things for employees. And that does have a cost. It's not as big as what you just talked about. Most of that impact is freight and logistics because, frankly speaking, airplanes weren't moving in the world. There's some other stuff that was very, very tactical last quarter, and some of that should abate over time. We'll find other routes to market. For example, we could use ocean freight to mitigate some of the costs of air freight and of the, extreme costs of air freight went out. There just weren't very many airplanes in the air. So, some of our costs went up. And I think that'll abate over time. We'll figure out operationally how we deal with this to get back into those margin ranges.
Okay. How should we think about your cash flow and prioritization? I will note that Seagate maintained its dividend. Many other companies that I cover in tech have suspended stock buybacks or dividends or reduced them or completely suspended them altogether. How should we think about cash flow and your capital allocation strategy?
Yeah, still very committed to the same capital allocation plans that we had before. We have faith in our long-term cash flow because the data is growing and we have a lot of levers to pull to make sure we satisfy it. So we make investments in ourselves, OpEx, CapEx, and then we share with shareholders, the cash that we have extra. We'll continue to always look at this, but, from my perspective, one quarter or 2 quarters where your cash may dip because you're dealing with something operationally is not a reason to change your long-term capital plan. If anything, I think there's opportunity because we have such faith in the long-term cash generations of this business. I think, we'll be continuing to look at what else we might do in the next 10 years. We said that at our analyst day last year, expressing long-term cash confidence. And from my perspective, the recent new economy, if you will, has actually driven data demand even stronger for mass capacity. So we're going to be looking at that.
And with, HAMR coming, as well as, 16, 18, 20 future expansions and more platters and, more memory that you're doing stuff, are there any CapEx needs we should be thinking about for cash flow that maybe isn't normal, whether it be expansions or, we see that the government in China is getting into some trade war tariffs about where technology can be shipped. How should we think about CapEx spending for your company?
Yeah, I think not yet. I mean, we'd have to see the whites of the eyes of the mass capacity really exploding before we needed to do anything fundamentally different. The way I would think about us is that when client server came down, we spent money to reorganize our factories away from client server devices and into mass capacity devices. So that was done a couple years ago. For the last few years, we've just been investing in the long time, lead time, wafer capital, media capital, and so on to meet the mass capacity ramps. We can still add a little bit from time to time. Our model is 6 to 8%. We've been underrunning that a little, and we'll watch cash very carefully. If the demand isn't there, then we're not going to invest, and we can run the capital a little bit lighter. But I think that's something that we have a very, very firm grip on. And from my perspective, we kind of control our own destiny in this front. I don't think we have to do anything extraordinary by making a massive investment to go make this happen. We can add a little bit incrementally when we see times are good, and we can pull back when we see the demand picture isn't shaping up the way we thought it was.
And when we're talking about demand, if we can kind of think about, how you view things, Dave, about demand. On your last earnings call, I believe guidance for fiscal 21 was relatively flat with 20. What are the puts and takes, especially with coronavirus, to make such assumptions like exabyte growth assumptions, or how should we think about what it takes to bridge from where we are now to then a flat? And again, flat's not a big bridge to cross, but there's a lot of uncertainty given coronavirus that's going on right now.
Right. And I think some of this is being borne out by the way we're seeing the market shape up. Certainly in the cloud, we recognized some of the disruption that was happening near term in the cloud. You can't build data centers if you can't get people on-prem to build the data centers, but you need to build more data centers. So, that tension and those, complex problems are there. Not only build more, but also just replace the old gear. If you're repurposing something that's 4 or 5 years old, it might be a 4 terabyte or 6 terabyte drive, and you're replacing it with a 16 or an 18 terabyte drive. That's a fairly, easy set of discussions, I think, to have. But what's hard about it is the logistics. On the other side, things like surveillance and some of the smart city applications that we all see coming were just so muted in our fiscal Q4 and our fiscal Q1. What we saw that we knew we were in the middle of that muted cycle, but we know that cycle will come back. So some of that is assumed. And then legacies, some of the legacy markets are slowly fading out. Some of them are more stable for a while on revenue. Consumer, for example, is fairly stable and, benefiting from the fact that people are moving data all over the world. Our consumer business ships more than 10 exabytes a quarter. So if you think about that, there's no real reason that demand goes away in a year or two. And that's why we can actually, forecast our revenue out that much time. The other thing is we spend a lot of time with our top 10 or top 20 customers, and they're all planning long term now. They're not, it's not a short term, I'll buy 2 extra pallets just to get me through this. I think we have the broadest portfolio in the market, so we're addressing a lot of legacy markets and transitionary markets to mass capacity or on-prem for them. And so we have great discussions with our customers about exactly, what their forecasts are. Nobody's perfect at this, but we have enough confidence to blend it all together and give that flat revenue guide.
And Dave, in that flat revenue guide, did you actually say what the exabyte growth should be? And I was trying to see versus trend line of what the exabyte growth is. Yeah.
No, we didn't talk about it, but you can imagine it'll be profound because it's still mass capacity continuing to grow at a clip of 35% plus, and then which we did talk about, and then some of the stuff that's actually lagging is the lower capacity points. You remember our average capacity per drive was over 4 terabytes, so that just keeps growing every quarter, and some of the stuff that's frankly 500 gigabytes or 1 terabyte isn't even really relevant anymore. So even with flat revenue, you'll see fairly profound exabyte growth.
Okay. On edge, I'm a big believer that edge computing is going to change a lot of things that we do in life and add more. That seems like there's an edge opportunity for storage. So you wanted to talk about edge a little bit. Do you subscribe to that? When do you think it will really kick in and start to materialize to impact Seagate for edge computing?
Yeah, it's a really interesting space and changing as well because of the new economy. I would say, kind of snarky comment from me would be you can't do edge computing without data, and that doesn't mean that everything needs a hard drive right next to it. What it means is that there's going to be, the data in the workflow is a very important asset. It's not just the compute processor. It's what happens to the data before you compute, after you compute, and how much longer before you have to pull it back in. All that's huge. And so there are a lot of mass capacity application spaces coming at the edge. We're very focused in this. And by the way, there's a lot of confusion about what exactly does the edge mean. Does that mean a colo that's, fairly close to the cloud, I'll say? Or does that mean, a neighborhood, pop or a data center or something like that? I think the answer right now is all of the above. We actually, we might even argue that mass capacity in a surveillance box or a smart city box is the edge. But as the application space grows, as the data just keeps on growing with IoT and with improved connectivity via 5G, that means there will be more of those points of presence for mass capacity. And we're actually pretty excited about it. We see this all the time in discussions we're having with customers.
Dave, sometimes we hear about customers sweating their assets, whether it be servers or extending, life of servers longer or on storage, things like data deduplication, additional compression standards. Any thoughts around, are we at a point of kind of just equilibrium right now, or are there new technologies coming that you find very exciting, or new technologies coming that you're like, oh, that's something new, because Jim Suva used to send my model to Shaney all the time. Now it's all sent via a link, and therefore it's probably less storage. How should we think about sweating of assets and technologies about, is there anything that could either accelerate or be a bit of a slowdown that we should be mindful of it as your CEO of a storage company?
People are always really smart, to your point. They don't want to spend extra money if they don't have to. They'll pivot to the cheaper model. But I would also say that, the kind of data growth that we're seeing now is not really, individual files and folders. It's more unstructured data growth. And, the idea of throwing that data away before you know what kind of value you can garner out of it is probably the people who can actually garner the data or garner the value are actually probably the ones who are going to win. So it all becomes a game of economics. Can I afford to just throw things away, or should I keep them for some kind of data processing later? Is a really interesting question. I'm sure there are a lot of people who will throw stuff away who turn around later and say, I wish I had that back. And we see this dynamic in customers right now. And again, it's not about, small files or, what we always think about, the Christmas list or something like that, although that data is important too. But we're usually talking in mass capacity about large data sets, large video data sets, large data sets about how factories operate and things like that. Stuff you don't exactly know where the value is in the data when you first, get it. And if you throw it away, it's gone for good. So, I think you're going to see less and less of that. You're going to see more people storing things for longer and having to make those tough trade-offs that you just talked about.
That's for sure. I've been known to get in trouble many times for throwing away something that I shouldn't have and regret it. As we kind of round things out, I have two questions. One is between you and Shaney, are there any key investor questions that you get asked that maybe you think people are off base or need some clarification or education on resolving such concerns? And then I want to wrap it up by Dave asking you the two or three top things that you think investors need to know about why they should be buying and owning Seagate Technologies and what keeps you so excited there as Chief Executive Officer. So first of all, on the investor education, anything that keeps coming up?
Thanks, Jim. I'll let Shaney have a crack here in a second because, obviously she's pretty tied in with the community. But what I would say is that my frustration, it kind of ebbs and flows. Sometimes questions come up, and it usually has the flavor of, aren't SSDs taking over hard drives or something like that? The answer to that question is maybe in some spots, but probably not anywhere else. And, as we've seen with the architectures in the cloud, mass capacity architectures, hard drives have a very, very solid footing in our world. The question is, how do some of those architectures actually go down into the edge and so on? We have strong opinions on that, but it all comes down to, value, terabytes per dollar, terabytes terabytes per watt, all kinds of other metrics. I hear people say all the time that, for example, this type of flash will take over hard drives in this market, and I don't think they understand those markets. I don't think they talk to those customers very much, and that kind of stuff gets frustrating to me because we have to answer all those things. But it waxes and wanes, doesn't it? Over time, I think some of these things have been proven to be, more just market hype than it is the reality of if you talk to customers about their architecture and what provides value. So, we get grounded again. Shani, I'll let you chime in as well.
Yeah, and it's funny what you said, Dave, is the first thing that came to mind because, Jim, maybe just going back to your earlier question around things like dedupe and whatnot, you think about how much data is being generated and how much data is being stored. The gap between those two is astronomical. And, I think that, our customers, our large data center customers specifically, are looking to the disk drive industry to support, just being able to store what they need. And so, I think there's a heavy reliance on us executing our technology roadmap, and we have a lot of confidence in that. So I think Dave answered that very succinctly. I think, the other thing that we get asked a lot is around the long-term revenue growth trajectory for the HDD business. And, it's been masked a little bit, and it's a key reason that we talk about our business in two key segments, the mass capacity and the legacy markets. Legacy has a long tail, but it is declining over time, and that provides us with great profit and great free cash flow contribution. What you're seeing, and actually for the first time in fiscal 20, mass capacity actually overtook the legacy markets from a revenue perspective. And if you just look at that portion of the business, it's been growing very nicely. And so it supports, our financial model of 2 to 6% revenue growth over the long term. And I think that that's something that we spend a lot of time trying to help investors understand.
Great. Thank you, Shani. And Dave, as we conclude and wrap it up as CEO, what's kind of the 2 or 3 things you want investors to walk away from this virtual conference to know about why they should be owning your company, buying the stock, and what keeps you excited as Chief Executive Officer of Seagate?
Yeah, I used to say I set my mood to how the market's going, and I set my mood to how the aerial density is going. I think we're right on the cusp of a big transition. We own the factories that really control it, the heads and media factories, the wafer fabs. It's a very sophisticated process. I think probably to your point about, investors, do they really understand how sophisticated a wafer fab is, what the lead times are, how hard it is to run? The world needs our products. And so, I think more than ever, we have a firm grasp on that control point. It's a tough world, very competitive out there, but I think the world's going to need mass capacity products for a long, long time. It's not just about 2024 or 2025. I mean, obviously data just continues to grow. We provide the best value out there for it. And our technology is making progress. So, that in that sense, I'm very excited. If I think back 5 years ago, watching client server decline was painful because you didn't know exactly where all those trends were happening. Now we're in the mode of secular growth of mass capacity, watching smart cities or watching big data centers continue to grow and knowing they're going to grow even more. I think it's a great firm footing for us.
Well, I want to personally thank Seagate for joining us, the Chief Executive Officer, Dave Mosley, and SVP and Head of Investor Relations and Treasury, Shani Hudson, for joining us here on Citi's Global Technology Conference. We certainly hope next year it will be live in person, but until then, this is the best we can do. It's Jim Suva and Seagate Technologies signing off, at least for this meeting with Seagate. Thank you so much, Dave and Shani.
Bye-bye.